I'm George Soros. I've been investing for over 70 years and I'm worth about $7 billion. People think that markets are driven by economics, by fundamentals, by rational analysis of supply and demand. But after 7 decades of making billions from market movements, I can tell you something that most people refuse to accept. Markets are driven by psychology, not economics. Every major fortune I've built, every crisis I've profited from, every billion-dollar trade I've made, it was all based on understanding one simple truth. Human beings are predictably irrational when it comes to money. And there are specific psychological tricks and biases that control their financial decisions, often without them even realizing it. These aren't academic theories. These are the actual psychological mechanisms that I've exploited to generate extraordinary returns. When I made $1 billion betting against the British pound, I wasn't betting against the currency, betting against the psychology of British policymakers who couldn't admit their strategy was failing. When I positioned against the housing bubble years before it collapsed, I wasn't analyzing mortgage data. I was analyzing the mass psychology that convinced millions of people that house prices could never fall. But here's what's really important. These same psychological tricks aren't just being used by sophisticated investors like me. They're being used against you every single day. Financial institutions, governments, media companies, and even your own brain are constantly manipulating your money decisions through psychological tricks that have been refined over decades. The investment industry makes billions of dollars by exploiting these psychological weaknesses. They know exactly which emotional triggers will make you buy high and sell low. They know how to make terrible investments seem irresistible. They know how to keep you trading frequently instead of investing wisely. Your own government uses these tricks to keep you confident in their economic policies, even when those policies are destroying your purchasing power. The media uses these tricks to keep you watching, clicking, and making emotional decisions with your money based on daily market noise instead of long-term strategy. Even your own subconscious mind works against you, using psychological shortcuts and biases that were useful for survival thousands of years ago, but are catastrophic when applied to modern financial decisions. Today, I'm going to reveal 5 specific psychological tricks that control your money decisions. These are the exact mechanisms that separate you from your wealth, that keep you making the same financial mistakes over and over again, and that ensure most people never build substantial wealth despite having access to the same markets and opportunities that create billionaires. But more importantly, I'm going to show you how to recognize these tricks when they're being used on you, how to defend against them, and how to turn them to your advantage the same way I have for 7 decades. Because once you understand how your own psychology works against you, once you can see the invisible forces that control your financial decisions, you'll never be manipulated again. Instead, you'll be able to exploit these same psychological patterns in others while protecting yourself from your own psychological weaknesses. This isn't about becoming emotionless or trying to eliminate psychology from your decisions. It's about understanding that psychology is the most powerful force in financial markets and learning to work with it rather than against it. It's about recognizing that the biggest battle every investor faces isn't against the market, it's against their own mind. Psychology trick number 1, the recency bias trap. This is perhaps the most destructive psychological trick that controls your money decisions, and it's so subtle that most people never realize they're falling victim to it. A recency bias makes you believe that whatever happened recently will continue happening in the future. When markets have been going up for months or years, recency bias makes you feel like they'll keep going up forever. You start believing that this time is different, that the good times will never end. This is exactly when you should be most cautious, but recency bias makes you most aggressive. When markets have been falling, recency bias makes you feel like they'll never recover. You become convinced that the economy is permanently broken, that stocks will keep falling indefinitely. This is exactly when you should be most aggressive, but recency bias makes you most cautious. I've exploited recency bias throughout my career. During the late 1990s, dot-com stocks had been rising for years. Recency bias made everyone believe that internet companies would keep growing forever, that traditional valuation metrics no longer applied. This mass delusion created the perfect setup for a spectacular crash. The financial media exploits recency bias systematically. When markets are up, they run stories about new millionaires and retirement wealth. When markets are down, they run stories about financial ruin and economic collapse. They know that recency bias makes you extrapolate recent trends into the future, which keeps you watching and trading. The investment industry uses recency bias to sell you exactly the wrong products at exactly the wrong time. After a bull market, they promote aggressive growth funds. After a bear market, they promote conservative income funds. They're always selling you yesterday's winning strategy just as it's about to stop working. Here's how to defend against recency bias. Create written investment rules. When markets are calm, and stick to them when markets are volatile. When everyone around you is excited about recent gains, that's your signal to be cautious. When everyone is depressed about recent losses, that's your signal to be aggressive. I force myself to ask, what if the recent trend reverses completely? How would that affect my positions? This simple question breaks the recency bias spell and forces me to consider scenarios that feel impossible but happen regularly in financial markets. Psychology trick number 2, the anchoring manipulation. Anchoring is one of the most powerful tools that financial institutions use to control your decisions, and most people have no idea it's happening to them. Anchoring makes you fixate on the first number you hear, even when that number is completely irrelevant to your decision. When a stock falls from $100 to $50, anchoring makes you think it's cheap because you're anchored to the $100 price. But maybe the stock was overvalued at $100 and is still overvalued at $50. The original price becomes an anchor that distorts your judgment about current value. Financial advisors use anchoring constantly. They'll show you an expensive investment first, then show you a moderately expensive investment that seems reasonable by comparison. They're anchoring you to the high price, so the medium price feels like a bargain. The media uses anchoring to manipulate your perception of market movements. When they say the market fell 500 points but recovered 300 points by close, they're anchoring you to the 500-point decline, making the 200-point net decline seem less significant. I've used anchoring to my advantage many times during currency crises. Pay attention to what price levels government officials defend most vocally. Those become psychological anchor points for other investors, creating predictable support and resistance levels that I can trade against. During the 1992 pound crisis, British officials kept insisting that the pound wouldn't fall below certain levels. They were creating anchors in other investors' minds. When those levels broke, the psychological anchors were destroyed, and panic selling accelerated the pound's collapse. To defend against anchoring, I always ask, if I knew nothing about this investment's price history, what would I think it's worth today? I try to evaluate every opportunity as if I'm seeing it for the first time, without any anchors from past prices or other people's opinions. The key insight is that anchors are everywhere in financial markets, and they're usually placed there intentionally by someone who wants to influence your decisions. Question every number you hear, especially the first one. Psychology trick number 3, the social proof trap. This psychological trick is responsible for virtually every market bubble and crash in history. Yet, most people fall for it every single time. Social proof makes you believe that something must be right because everyone else is doing it. When you see your neighbors getting rich from real estate, social proof makes you want to buy real estate too, even if prices have become irrational. When you see day traders making money from meme stocks, social proof makes you want to trade too, even if you know nothing about the companies. Social proof is particularly dangerous in financial markets because it creates reflexive feedback loops. When more people buy because others are buying, prices rise, which attracts even more buyers, creating bubbles that eventually collapse catastrophically. The investment industry deliberately exploits social proof through marketing that emphasizes how many other people are using their products. They show testimonials from ordinary people who got rich following their advice. They publish statistics about inflows to their funds. All of this is designed to trigger your social proof instincts. I've profited enormously from social proof by doing the opposite of what everyone else is doing. During the housing bubble, social proof was telling everyone that real estate was the safest investment. Everyone knew someone who had made money flipping houses. This universal acceptance told me that the bubble was mature and ready to burst. The key to exploiting social proof is recognizing that when everyone agrees about an investment, the easy money has already been made. When something becomes so popular that your taxi driver is giving you advice about it, that's your signal that social proof has pushed prices to unsustainable levels. During the dot-com bubble, I watched as social proof convinced millions of people that they needed to own internet stocks. Everyone had stories about their friends getting rich from day trading. This wasn't analysis, it was mass psychology driven by social proof. To defend against social proof, I deliberately seek out contrarian opinions when everyone seems to agree. I ask myself, what if the majority is wrong? What if this popular investment is actually a trap? I also pay attention to what successful investors are doing quietly, not what they're saying publicly. The most important insight about social proof is that it works in reverse during market crashes. When everyone is selling because everyone else is selling, that's often the best time to buy. But you have to train yourself to resist the social proof that's telling you to follow the crowd into panic selling. Psychology trick number 4, the loss aversion control system. Loss aversion is probably the most expensive psychological trick that controls your money decisions. It makes you fear losses more than you desire equivalent gains, which leads to terrible investment behavior that keeps you poor. Loss aversion makes you sell winning investments too early because you are afraid of giving back your gains. It makes you hold losing investments too long because you can't bear to realize the loss. This combination, selling winners and holding losers, is exactly backwards and destroys wealth systematically. The financial industry exploits loss aversion through marketing that emphasizes protection and safety over growth and opportunity. They sell insurance products and guaranteed returns that feel safe, but provide returns so low that inflation destroys your purchasing power over time. Fund companies use loss aversion to keep you invested in mediocre funds by emphasizing that you won't lose money, while quietly charging fees that guarantee you'll underperform the market. They know you're more afraid of losing money than you are excited about making money. I've turned loss aversion into an advantage by recognizing that other investors' loss aversion creates opportunities for me. When everyone is afraid of losses and selling good investments at low prices, I'm buying when everyone is afraid of missing gains and buying poor investments at high prices. I'm selling. During the 2008 financial crisis, loss aversion made most investors focus obsessively on avoiding further losses rather than positioning for the inevitable recovery. They sold everything and moved to cash, locking in their losses and missing the subsequent bull market. I did the opposite. I recognized that loss aversion was creating once in a generation buying opportunities, while everyone else was paralyzed by fear of further losses. I was aggressively buying high quality assets at deeply discounted prices. The key to overcoming loss aversion is reframing how you think about gains and losses. Instead of thinking about individual positions, think about your overall portfolio over long time periods. Instead of trying to avoid all losses, try to make your losses smaller and your gains larger. I also use position sizing to manage loss aversion. By investing small amounts in many different opportunities, I reduce the emotional impact of any single loss while maintaining upside from the positions that work. This systematic approach prevents loss aversion from sabotaging my decision making. Psychology trick number 5, the overconfidence delusion. The final psychological trick is perhaps the most dangerous because it makes you feel smart while it destroys your wealth. Overconfidence makes you believe you can predict the future more accurately than you actually can, leading to concentrated bets and excessive trading that erodes returns. Overconfidence is particularly dangerous after you've had some investment success. Early wins make you believe you've figured out the market, that you have special insight or skill that others lack. This leads to larger positions, more frequent trading, and increased risk-taking, just as your luck is about to run out. The financial media feeds overconfidence by presenting complex economic and market analysis as if the future were predictable. They interview experts who speak with certainty about what will happen next, making you believe that successful investing is about making accurate predictions. Day trading platforms exploit overconfidence by showing you real-time data, sophisticated charts, and professional-looking tools that make you feel like a professional trader. They know that overconfident amateur traders generate enormous trading fees while losing money consistently. I've learned to profit from others' overconfidence while guarding against my own. When I see investors making large, concentrated bets based on their predictions about the future, I often position against them because overconfident investors typically underestimate risks. During the tech bubble, I watched as overconfident investors borrowed money to buy more internet stocks, convinced that they had discovered the secret to easy wealth. Their overconfidence created the conditions for the spectacular crash that followed. The antidote to overconfidence is intellectual humility. I constantly remind myself that I don't know what will happen next, that my track record doesn't guarantee future success, and that the market is always capable of surprising me in ways I don't expect. I also use systematic rules to prevent overconfidence from influencing my position sizing. No matter how convinced I am about an opportunity, I never risk more than a predetermined percentage of my capital. This protects me from the catastrophic losses that destroy overconfident investors. The key insight is that overconfidence feels good. It makes you feel smart and in control. But those feelings are warning signs that you're about to make expensive mistakes. The most successful investors are often the most humble about their ability to predict the future. Conclusion: turning psychology from enemy to ally. These 5 psychological tricks, recency bias, anchoring, social proof, loss aversion, and overconfidence, control most people's money decisions and keep them from building wealth. But once you understand how they work, you can defend against them while exploiting them in others. The goal isn't to eliminate psychology from your investing, while that's impossible. The goal is to understand how psychology works and structure your decisions accordingly. Use written rules to override emotional impulses. Use systematic approaches to prevent biases from distorting your judgment. Use position sizing to limit the damage when psychology works against you. Most importantly, remember that these psychological tricks are being used against you constantly by people who profit from your poor financial decisions. Recognizing these tricks is the first step toward financial independence, because once you can see the invisible forces controlling your money decisions, you can finally take control of your financial future. After 7 decades of exploiting these psychological patterns, I can tell you that understanding psychology is more valuable than understanding economics, more profitable than financial statements, and more important than predicting market movements. Master your psychology and you'll master your financial destiny.